The Eurodollar trap, when global dollar hegemony becomes a domestic liability. Introduction. In the post-war era, the United States emerged not only as the dominant global power, but also as the architect of the international monetary system. What followed was the rise of the Eurodollar system, a network of offshore USD deposits and debt instruments circulating outside the reach of the U.S. Federal Reserve. Initially seen as a brilliant geopolitical workaround, this shadow system allowed the dollar to extend its influence globally, servicing trade, finance, and diplomacy without immediate domestic cost. But over time, that strength metastasized into a structural vulnerability. The U.S. now finds itself in a paradox. It is forced to serve the very global system it once commanded, as the long-term bond market, driven largely by foreign holders of U.S. treasuries, now effectively limits the scope of U.S. domestic policy. This is not just a historical curiosity. The Eurodollar trap is a blueprint of how not to construct a monetary system. It exposes the risks of bundling monetary functions, outsourcing credit, and allowing ungoverned liabilities to accumulate in the name of global leadership. This exposition traces the Eurodollar's origin, evolution, and breakdown. It also draws critical design lessons for the future of monetary architecture, particularly for credibly neutral systems like the Goldbit Unit GBU protocol, which seek to sidestep the same liabilities through architectural clarity and function separation. Section 2. Historical Genesis, the Eurodollar workaround. The Eurodollar system was not born from a formal treaty or economic doctrine. It emerged as a pragmatic workaround, a geopolitical improvisation that solved an immediate problem for both dollar-hungry nations and the United States itself. In the early Cold War years, countries like the Soviet Union and its allies wanted to hold and transact in U.S. dollars, but feared that their assets could be frozen or seized if held in the American banking system. European and British banks responded by accepting dollar deposits and issuing dollar-denominated loans entirely outside the legal and regulatory reach of the Federal Reserve. These were the first Eurodollars, not because they had anything to do with the euro, which didn't yet exist, but because they were dollars held in Europe. This offshoring of dollar liquidity was tolerated, if not outright encouraged, by U.S. policymakers. Why? Because it increased global demand for the dollar as a reserve and transaction currency, reinforced American economic dominance without requiring additional domestic issuance, created a powerful tool for soft power. Dollar access became a diplomatic lever. The Eurodollar market grew rapidly. By the 1970s and 80s, it had become a shadow monetary system, capable of issuing credit and mobilizing capital without the Fed's oversight. Crucially, it remained denominated in USD, meaning that liabilities issued offshore still referenced U.S. debt instruments, U.S. inflation expectations, and U.S. policy risk, without giving the U.S. any governance rights over those instruments. This was the foundational flaw. What began as a clever liquidity solution ultimately grew into a structural contradiction: U.S. liabilities without U.S. control. The market rewarded the U.S. in the short term: cheaper borrowing, global reach, and a dominant position, but it planted the seeds for long-term instability. Section 3. Functional confusion, unit of account versus store of value. At the heart of the Eurodollar system's eventual dysfunction lies a category error, a failure to distinguish between the fundamental roles that money must serve. This confusion wasn't just theoretical. It produced a cascade of practical consequences that now restrict U.S. financial autonomy. Money typically serves three functions. 1. Unit of account UOA, a standard of measurement for value, e.g. pricing oil in USD. 2. Medium of exchange, MOE, a mechanism for transferring value. 3. Store of value, SOV, a way to preserve value over time. The Eurodollar system bundled these functions into one instrument: offshore USD deposits and U.S. treasuries. It priced goods and services, UOA, facilitated settlement across borders, MOE, and served as a savings and collateral instrument for sovereigns and institutions, SOV. But here's the problem. Each function carries different liabilities and requires different governance. UOA can be abstract and sovereign agnostic. It simply needs to be stable and widely accepted. SOV, by contrast, is a claim on future value, and in the case of treasuries, it is a claim on the U.S. taxpayer in the form of interest payments. In conflating these roles, the Eurodollar created a dangerous asymmetry. Foreign entities could price and transact globally in USD, UOA plus MOE, and store vast reserves in treasuries, SOV, accumulating claims against the U.S., but without giving the U.S. reciprocal rights or policy influence. This is like allowing foreign states to use your household budget as a global savings account. You gain prestige, but eventually lose control of your spending. The medium does not equal the asset. A further insight: the medium of exchange is not the asset, it's the rail. Think of the MOE as a conduit or infrastructure layer, akin to Fedwire or ACH, domestic rails, SWIFT, CHIPS or mBridge, international rails, or Layer 2 networks in crypto, e.g. Lightning. These rails transport value, but they don't define what that value is. In that light, USD, EUR, BTC are the cargo, Fedwire, SWIFT, etc. are the sea. What the Eurodollar system did was allow foreign vessels to carry U.S. cargo across oceans the U.S. Navy didn't patrol, while still holding the U.S. responsible for the cargo's value. This blurred boundary between rails, currency, and liability is the technical and architectural root of the trap. Section 4. Triffin Dilemma realized: the long end of the curve as a leash. The Triffin Dilemma, first proposed by economist Robert Triffin in the mid-20th century, describes the inherent conflict faced by a nation whose currency serves as the global reserve. To supply the world with liquidity, it must run persistent trade and fiscal deficits, eventually undermining the stability and credibility of its own financial system. For decades, this dilemma appeared manageable. The U.S. enjoyed the benefits of dollar hegemony: cheaper capital, elevated global influence, and deep demand for its debt. But with the maturation of the Eurodollar system, these benefits have metastasized into liabilities. Massive foreign-held reserves of U.S. Treasuries now act as external pressure points, dictating policy boundaries through the bond market rather than democratic consensus. Case in point, the tariff backtrack. On April 2, 2025, President Trump announced Liberation Day, introducing a bold new wave of tariffs aimed at restoring American manufacturing dominance and recalibrating global trade flows. The announcement was widely publicized and positioned as a show of economic sovereignty. But the bond market interpreted it differently. In the days following the announcement, yields on the 10-year and 30-year U.S. Treasuries rose sharply. The 10-year initially dipped to just under 4.0 cent, a momentary flight to safety, but by April 11, it had surged to approximately 4.49%, a 50 basis point swing. The 30-year yield mirrored this rise, marking the steepest one-week increase since 1987. The sell-off was not simply technical. It reflected deep concern from global investors about the fiscal and inflationary consequences of aggressive trade policy. Elevated yields meant higher borrowing costs, not just for the U.S. government, but for the entire economy. On April 9, just 1 week after the tariffs were announced, the administration walked back key components of the plan, issuing a 90-day pause on full implementation to allow for further negotiations. Though framed as a strategic reassessment, the timing strongly suggests this was a forced policy retreat, triggered not by Congress, not by public opinion, but by foreign bondholders exerting power through the long end of the yield curve. This episode confirms a harsh new reality. U.S. domestic policy is now constrained by international capital markets. The Federal Reserve retains control over short-term rates, but long-term yields, those that shape mortgages, infrastructure financing, and budget projections, are increasingly governed by global sentiment. The leash is no longer political, it's financial, and it's held by those who buy or dump America's debt. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. V. The Hegemon's Dilemma: preserve power or save the core. The United States now faces a stark strategic choice, one that no empire has historically been able to avoid forever: preserve global monetary dominance at the cost of internal decay, or reclaim domestic sovereignty at the cost of global monetary fragmentation. This is the Hegemon's Dilemma, and it lies at the heart of the Eurodollar trap. Option 1. Preserve dollar hegemony. To maintain the dollar as the global reserve currency, the U.S. must continue issuing debt at scale to meet global demand for treasuries, running trade deficits to export dollars for global settlement, tolerating external influence on long-term capital markets, paying interest on trillions in foreign-held liabilities, now surpassing spending on Social Security and defense. This keeps the U.S. at the center of the global financial system, but erodes its internal maneuverability. Budgetary priorities become constrained by debt servicing. Foreign holders effectively vote with bond sales. Domestic policy is held hostage by international confidence. Option 2. Prioritize domestic stability. To reclaim internal control, the U.S. would need to limit the use of treasuries as global SOV, reduce issuance and cap external liabilities, assert stronger regulatory oversight of offshore dollar markets, possibly introduce capital controls or dual dollar frameworks, onshore versus offshore units. But doing so would trigger a global sell-off of U.S. debt, spiking yields, undermine the trust and utility of the dollar in international trade, invite alternative monetary blocks, e.g. BRICS, digital SDRs, gold-backed systems, to fill the vacuum. In short, saving the core could break the empire. The fork in the road. Historically, monetary hegemony has been a privilege bought with discipline. The issuer had to keep liabilities in check, maintain convertibility, and serve as a lender of last resort. But the Eurodollar system mutated this arrangement. Foreign users could accumulate claims without offering reciprocity. The U.S. got influence, but no off switch. Now, as rising interest payments devour discretionary budgets and long-term rates are increasingly set abroad, the U.S. faces the reckoning it postponed for decades. You can either be the world's central bank or your own, but you cannot be both forever. Section 6, Design Lessons for Future Monetary Systems. The Eurodollar system is more than a cautionary tale. It is a blueprint of failure by design omission. Its long-term consequences reveal what happens when a monetary system is built without functional boundaries, governance clarity, or liability controls. To avoid repeating this mistake, future monetary systems, especially those attempting global relevance, must internalize several non-negotiable design principles. 1. Separate monetary functions at the protocol level. Key lesson: do not bundle unit of account, UOA, store value SOV, and medium of exchange, MOE, into a single instrument. UOA should be abstract, low volatility, and purely informational, used for pricing, accounting, and contract denomination. SOV should be risk-managed, yield-bearing, and optional, used only by those who explicitly choose to store value. MOE is the infrastructure, the plumbing, not the money itself. Think SWIFT, Fedwire, or blockchain L2s. Bundling all three into one system, like USD plus Treasuries SWIFT, leads to perverse incentives and uncontrollable liabilities, as the Eurodollar system proved. Don't issue global liabilities without global governance. Key lesson: external obligations without reciprocal rights lead to systemic imbalances. The U.S. issued trillions in sovereign debt that now serves as the rest of the world's savings vehicle. But there is no international forum where foreign holders vote on U.S. fiscal or monetary policy. They hold the power, via sell-offs, without any accountability. A global monetary system, if it must exist, must be credibly neutral, governed by multi-stakeholder consensus, e.g., DAO, treaty framework, or cryptographic protocol, transparent in operations and obligations, limited in liability exposure. 3. Protocol-level modularity and adaptability. Key lesson: design for evolution, not stasis. Future systems like the gold bit unit, GBU, must be adaptable to macro and political shifts. Modular backing, e.g., gold, BTC, fiat tranches. Swap-capable architecture for changing regulatory environments, e.g., CBDC-only economies. On-chain FX engines to handle cross-tranche transitions. When Japan, the EU, or others enforce local CBDC-only settlement rules, GBU must be able to swap its fiat layer dynamically, USD, JPY, or EUR, without disrupting its UOA stability. 4. Use the sea and cargo model for clarity. Key lesson: medium of exchange does not equal value itself. The rails are the sea, SWIFT, Fedwire, mBridge, crypto layer 2s. The currencies or tokens are the ships, USD, BTC, EUR, GBU. The store of value is the cargo, what's actually preserved, priced, or claimed. This model keeps designers from confusing the transport mechanism with the financial liability. In short, future systems must be transparent, modular, and constitutionally sound. Every function must have clear permissions, limitations, and pathways of control. Otherwise, even the most elegant monetary architecture will eventually collapse under the weight of its contradictions, just as the Eurodollar system has. Section 7. Future-proofing, navigating the CBDC fragmentation era. As central banks around the world roll out their own digital currencies, a new form of monetary fragmentation is emerging, not based on currency type, but on sovereign-controlled digital settlement rules. In this future, cross-border transactions will no longer be governed solely by FX markets or SWIFT, but by national and regional CBDC infrastructure, each with its own rules, permissions, and domestic settlement mandates. This presents a challenge and an opportunity for global monetary protocols like GBU, gold bit units. A. The rise of local settlement constraints. Consider these likely near-future scenarios. Japan mandates that all domestic retail and institutional payments settle in JPY CBDC. Europe restricts high-volume Eurozone transactions to EUR CBDC rails. China requires all imports into the mainland to be invoiced and cleared in eCNI. In such a world, a single static fiat leg in a global UOA system becomes unworkable. To remain interoperable, the GBU protocol must adapt dynamically to the realities of each monetary zone. GBU's adaptive design, modular fiat tranches, plus on-protocol FX. The GBU system solves this through 3 architectural layers. Let me walk you through the GBU protocol architecture, top-down, starting where it all begins, the collateral layer. Collateral store of value, top layer. This is where real value is secured. The protocol uses BTC, tokenized gold, and high-grade fiat instruments as collateral, hard, globally recognized stores of value. This layer is designed to withstand inflation, monetary debasement, or sovereign volatility. These are the anchor points, what ultimately backstops the credibility of the entire system. Fiat tranche, middle layer. Next, we have the fiat tranche layer. This is where local monetary compliance is handled. When a country introduces regulatory requirements, say only JPY CBDC may be used in domestic payments, the protocol simply swaps in that fiat tranche using smart contract logic. USD, EUR, JPY, it doesn't matter. The system is modular and programmable. This allows GBU to stay interoperable across jurisdictions without requiring every participant to use the same fiat leg. Unit of account layer, bottom layer, GBU token. Finally, at the bottom is the GBU token itself. This is the unit of account, stable, protocol-defined, and detached from any single nation-state. Pricing, invoicing, and contracts all reference this token. It's what users see. The underlying SOV and fiat tranches may adapt over time, but the GBU unit remains a consistent measure of value. This architecture achieves what legacy systems like the Eurodollar could not: separation of powers between pricing, collateral, and settlement, modular adaptation to changing geopolitical and regulatory conditions, and most importantly, a credibly neutral unit of account that doesn't drag sovereign liabilities with it wherever it goes. Now, let's walk through a practical scenario. When a local rail mandates JPY CBDC, say for compliance with Japanese payment law, the GBU system automatically swaps in the JPY tranche. Users in Japan continue to invoice and settle in GBU, but behind the scenes, the fiat component is now anchored in JPY CBDC, not USD. The store of value remains intact. The unit of account remains unchanged. Only the fiat tranche shifts. This allows GBU to respect local monetary sovereignty without breaking global composability. A built-in FX engine handles the conversion transparently, referencing on-chain oracles and AMM pools to ensure price accuracy and slippage protection. Section C, Medium of Exchange, MOE as a permissioned layer. Because settlement rails become jurisdictional, sometimes permissioned, GBU treats MOE not as part of the token, but as an attachable module. For example, in Japan, GBU JPY could be routed through a CDC-compliant payment adapter. In the EU, GBU UR interacts with digital euro clearing via API bridges or legal wrappers. This ensures compliance with sovereign constraints, preservation of GBU's monetary neutrality, liquidity routing across fragmented CBDC jurisdictions. Section D, Outcome Stability across fragmentation. Instead of being rendered obsolete by CBDC fragmentation, GBU becomes the coordination layer, a unit of account that remains consistent across jurisdictions, a modular system that speaks every sovereign payment language. a neutral zone where real assets back digital value, and protocol logic replaces political fragility. In this way, GBU offers what the Eurodollar system never could, a structure that flexes with global constraints while protecting its core design principles. Conclusion: toward a new standard. The collapse of internal-external balance in the Eurodollar system is not just a cautionary tale for the United States. It is a structural warning to the world. It demonstrates the endgame of a monetary system that bundles too many functions, allows external liabilities to outpace governance, and fails to enforce clear boundaries between domestic policy and global obligations. The lesson is not to fear global money, but to design it deliberately. What the Eurodollar got wrong. It outsourced credit creation without limits. It blurred the line between pricing tool and savings instrument. It granted external actors leverage over long-term domestic policy without giving them a seat at the table. And most critically, it offered no protocol-level safeguards to contain or rebalance these risks. The U.S. dollar's strength became its weakness. Its dominance demanded ever-expanding debt issuance, and now the system has matured into a trap. Either continue feeding the global machine and sacrifice internal flexibility, or pull back and risk a geopolitical and economic reset. What future systems must get right? A post-Eurodollar standard cannot come from another hegemon. It must come from architectural neutrality and design constraints that limit systemic exposure. The gold bit unit GBU system embodies this principle through function separation. UOA, SOV, and MOE are distinct and modular. Credible neutrality. No single nation controls the rules, issuance, or collateral. Liability minimization. No uncontrolled interest-bearing claims accrue externally. CBDC compatibility. GBU adapts to sovereign payment environments without breaking coherence. This is not utopianism. It is structural realism. A well-designed monetary system should not promise dominance. It should promise durability. And durability is born not from empire, but from clarity, modularity, and constraint. Final takeaway. If you want to understand how not to build a monetary system, study the Eurodollar. Opaque governance, mismatched functions, and unbounded liabilities. The next era of money, if we are to have one that survives the next 50 years, must learn not only from what we created, but from what we failed to contain.